A flexible approach to selling your investments. When it comes to investing in stocks, the timeless wisdom dictates searching for quality companies at the right price. But navigating the world of buying and selling stocks is far from a straightforward task. It goes beyond merely reacting to changes in price. Savvy investors must also take into account the unique characteristics of the companies they hold in their portfolios. Additionally, the diverse landscape of investors, ranging from value-oriented to growth-focused on fundamental analysis, further complicates the matter. One essential truth to acknowledge is that what works as a selling strategy for one individual may not yield the same results for someone else. Consider, for instance, a short-term trader who employs a stop-loss order, set at a 3% decline, to mitigate potential losses. This approach proves effective in limiting losses and is not limited to short-term traders. Investors with a 3 to 5 year investment horizon can also adopt it. However, for longer-term investors, the stop-loss percentage may need to be considerably higher, say around 15%, due to their extended investment horizon. It's worth noting that as the investment horizon stretches even further, the utility of the stop-loss strategy diminishes. Key questions to ask before selling. To determine whether selling is the right move, it's crucial to align your selling strategy with your unique investment style. Begin by asking yourself these fundamental questions. Why did you purchase the stock in the first place? Reflect on the initial reasons that led you to invest in the company. Was it because of a strong balance sheet, innovative technology, or some other compelling factor? What has changed since your initial investment? Evaluate the shifts that have occurred since you first bought the stock. Changes in price are typically accompanied by underlying reasons. Does the recent change impact your original investment rationale? Assess whether the modifications that have taken place align with your original investment thesis. It's vital to not only consider your initial reasons but also to examine recent headlines and Securities and Exchange Commission (SEC) filings for any developments that could alter your investment thesis. If you've determined that a substantial change has occurred, proceed to the third question: has this change been so significant that you wouldn't invest in the company again today? If the alteration, such as a shift in the company's business model, undermines your original investment rationale, it's advisable to divest your position in the company. Emotional detachment leads to sound selling decisions. Maintaining emotional detachment from your investments is crucial for making sound selling decisions. By avoiding emotional bias and staying focused on your investment thesis, you'll find it easier to make informed choices when it's time to sell. When to part ways with a losing stock. The timing for selling a losing stock depends on your overall trading strategy and portfolio composition. If the underperforming stock represents a small portion of your portfolio and isn't significantly dragging down your portfolio's overall value, you might consider holding it for an extended period. Alternatively, if the stock pays a healthy dividend, it could justify holding onto it despite losses. However, as a general guideline, if a stock breaches a technical marker or the company's performance deteriorates, it's often wiser to cut your losses rather than allowing the position to tie up your capital, potentially leading to further declines. Optimal timing for selling stocks. The stock market's highest liquidity periods typically occur during regular trading hours, particularly at the market open and about 10 minutes before the closing bell. While many large companies offer instantaneous trade execution throughout the day, smaller companies may experience delays in order fulfillment, especially if there are no counterparties on the other side of the trade. This lag can become more pronounced during after-hours or pre-market trading sessions when liquidity is limited.